Good morning. We're here at the NASDAQ Marketsite at Times Square, New York. And I'm Jean-Loup from BioBusiness TV, and we are very pleased today to welcome Stelios Papadopoulos.
Good
Welcome,
morning.
Stelios.
Thank you. Good to be here.
Good to have you today. It's a great honor and a great pleasure to have you with us. You are the one maybe with the most prestigious career in the field of biotech finance and creation of companies, with being an analyst and being a banker, an investment banker, and being also an investor yourself and helping to create companies like Genzyme or Exelixis and many other companies. So today we are opening with you a new series called Visionaries, and you're the first guest. It's to have your vision of the field of biotech. We heard for many years that it's a dry season for biotech. They cannot raise any money. It's a bad time for biotech. Then it's a good time again. So what are we facing today, and what do you see which is missing maybe in a biotech today? How do you see your vision for the 20 years coming? And also, maybe more practically, right now, what's the next transition period? Stelios.
Well, thank you very much. Thank you for having me here. Thank you for the honor of my being the first person in your new series, and all the luck in your new endeavor. You raised a lot of points, a lot of good points, and I'll try by memory to take them one at a time. First, in some sense, the reward of being old is that you've been around long enough that on occasion you've been early in something, and having been early in something makes you look smarter than you are. So I appreciate all the good compliments. I was lucky to get involved with biotech very early in the beginning, and I think that's probably a lot more than anything else that has contributed to my role in the industry. So let's talk about the financial situation in the near term. No doubt it's difficult raising money. One does not have to engage in sophisticated analysis. You look at stock prices, you look at the amount of financing in recent weeks, and you recognize that it's been a difficult environment. In fact, it's been a different environment in the last 3 or 4 years than it's been ever before. And I want to point that out more in greater detail. Say from 1980 until the early part of the century, the market for biotech stocks was a more or less cyclical event. Every 3, 4, or 5 years, somewhere there would be a very permissive market. Many IPOs will get done. Many companies will raise money. Then we'll go into a quiet period for some time. And after that, back again with the excitement. The last big market of that nature was in the year 2000. And it's by any statistical measure, it was the biggest ever biotech IPO market of all time. It was the biggest and best time to raise capital for any company in the biotech sector. Since the year 2003, we've been operating what I call a windowless paradigm. It's an environment where you could raise some money, not a lot of money, not as freely and as good a price as you did before, but it's not completely shut down either. And it varies by the type of company, by the month of the year, by a variety of external events, but it's a more mature-like behavior than that old window every 3 years or 5 years cyclical behavior. Now, what is causing this, and that's the important point, is a number of factors. And I think in large part, what we now have on the market, in the marketplace on the part of investors is far greater sophistication. We now have investment funds that are managed by individuals with first-class scientific backgrounds. Back in the 80s, most of the scientists on Wall Street were rather poorly trained in science to begin with. The guys today are extremely well trained in medicine or in basic science. They possess a good understanding of the marketplace. They understand what the trading of stocks is all about. A number of these firms have institutional memory. They now, even though the individuals may not have been there for 20 years, there is now the communication from one to the next fund manager of what has transpired, so they can put things in perspective. That, coupled with the fact that the bulk of the money invested in biotech today, on a proportional basis compared, say, to 20 years ago, there's a lot more hedge fund money than 20 years ago. Hedge fund money is good money. I don't mean to appear as someone who is critical of hedge funds because these are bad guys. They're not. As one would say, some of my best friends are hedge fund managers. The only issue is that most hedge funds are under pressure to perform sooner rather than later. So it's not easy for them to invest a lot of their capital in 5 to 10 year investment horizons. And some of the biotech companies take that long. So the sophistication on one hand of the investment public, the lack of willingness to invest for the longer term, that is making it a lot more difficult for companies to raise money in that crazy responsible way we used to have before.
But what about the innovation, the cost of innovation today, or maybe the lack of productivity in this sector?
Well, these are two very important linked questions. Is the sector productive, and is the cost of innovation different than it used to be? In some ways, the cost of innovation is much higher today than it was 20, 30 years ago. And that has to do a lot with the fact that most of the innovation in biotech 20, 30 years ago was really the discovery, development, and introduction to the marketplace of novel proteins, some of which were actually well known prior to that. Biotech simply offered a production methodology to bring them into the marketplace as medicinal products. Nowadays, in a science-based company, we need to begin with some fundamental scientific principles, develop a biological system, develop appropriate assays, identify suitable targets, validate those targets, begin doing some screening, come up with some hits, optimize those, take those leads, put them into preclinical animal models. That timetable alone, could be 5 to 10 years. And that's what it used to take in the 80s for a company to come from first principle to commercial maturity. So the time is different because we're tackling problems on a more fundamental basis, simply because there's no easy way to deal with complicated problems. It's not as if we're choosing to do this. That's the only way we can tackle complex situations like Alzheimer's or some of the other more difficult conditions. So that additional time element, the cost that goes with it, can all, of course, translate into an apparent lack of productivity. What we don't do is we don't correct for the degree of difficulty of the problems we're trying to solve, which are much tougher today than they were 20, 30 years ago.
So are we where we're expecting to be 20 years from now? If you go back 20 years from now, do you see we are where we said, or you said we will be?
Yeah, nobody ever does that because Wall Street looks forward and forward only. I've thought a lot about it many times because I actually still have research reports I wrote as an analyst back in the early mid-'80s. And here's what I recall. If you asked me in the mid-'80s where biotech was going to be 20 years later, I probably would have believed that we would be reaching commercial success sooner, but my expectations of the size of commercial success were far lower, far smaller than what the case turned out to be. I couldn't have envisioned in the 80s companies in biotech with, $5 billion in sales and market capitalization of 50 to 100 billion. I could not even imagine that. The pharmaceutical sector, keep in mind, I produced an interesting slide once in a study, in a lecture I'd given, comparing the biotech sector in the year 2000 in terms of the size of companies with the pharmaceutical sector in the year 1990, just a 10-year lag. In that 10-year lag, you could see a virtual superimposition. In other words, pharma in 1990, what biotech was in the year 2000 in terms of numbers of companies, market capitalizations, numbers of significant companies, not total number of companies. So it would have been very difficult in 1985 to envision $50 billion market cap companies when, if I remember correctly, even Merck, the flag bearer of pharma, in 1990 had a 35 billion market cap.